Okay, I'm going to go ahead and get started then. Welcome so much to the webinar today. My name is Tracy Russo. I'm with HTA Insurance Services. We're located in Pennsylvania, and we help people with their preparing for retirement plans. So either long-term care planning, which of course is what this webinar is about today, or Medicare planning, and we can help with both. And we have a team of qualified professionals here, all salaried employees of mine. So if you ever call our office, you're not on the phone with somebody who earns a commission for selling you a product. You're on the phone with somebody who is a salaried employee, who is a specialist in their field, and who is paid to educate you on what your options are and help guide you to the most appropriate solution, whether that be for Medicare planning or long-term care planning. So today I hope to give you a nice overview and education on what's involved in long-term care planning, what the different long-term care protection strategies are, and some sample pricing. Of course, if you're interested in learning more about this for yourself or for a family member, you can always give our office a call. The last slide will have our contact information on it, and you can schedule a free consultation. So it would be an hour phone appointment where you meet with one of our long-term care specialists. We talk about your needs, your objectives, your budget, and we can help you put together some solutions that might be meaningful to you for you to review with your spouse and or family and consider for protection. So if you find that this information is interesting to you, but you want to know some numbers that are relevant to you specifically, just simply give our office a call and get an appointment on the calendar with one of our long-term care specialists, which may be me, maybe Nicole, Anya, Brenda. There's a few of us here that do this that you would be working with. Okay, so I'm just going to jump right in. What is long-term care? And a lot of the times when we think of long-term care, we think of nursing home care and end-of-life situations. And really, there's a lot involved in that topic of long-term care. So I'm going to start kind of from the bottom and work my way up. So the ones that most people think of when they think of long-term care is the more skilled type stuff, physical, occupational, or speech therapy, nursing type services, things that you would get in more of an institutional nursing home environment. But it contains a lot of other things like transportation services, homemaker services, and personal services. These are all things that need to get done for you to have some form of normal functional life, like managing your medications, paying your bills, housekeeping, grocery shopping, getting to and from doctor visits. And then the top two bullet points, these talk about specifically what are considered relevant long-term care needs under a long-term care insurance policy. So help with normal daily activities, such as dressing, bathing, transferring, which would be getting in and out of a bed or a chair, eating, toileting, and continence. Those are considered your activities of daily living, or ADLs. Or if you need supervision because of a cognitive impairment. So everything on this screen is what's considered, when you hear the term long-term care, it could mean any of these services. But when we're talking about long-term care insurance policies, a lot of the times that you'll find the first two bullet points, the help with the activities of daily living and the cognitive impairment, are what's going to make you eligible to collect insurance money to pay for all of these services that you see on the screen here. Now, these services can be provided in a number of environments. At home or in the community. Community would be things like adult daycare centers. If you've ever had a loved one, maybe you were caring for a parent at some point and you still had to work, so you took them to a senior center or an adult daycare center during the day and then brought them home with you at night. Having people come into your home, of course, for home health aides, nursing assistants, things along those lines. Assisted living apartments, these are 1 or 2 bedroom apartments. They're in a facility that there's people on staff that can come in to check on you, but really you have your own living space with your own apartment, but there's call buttons within the apartment. They have scheduled visits throughout the day so people can come in and take care of you. But it's a much more comfortable living environment than the next bullet point down, which is a nursing facility. So a skilled nursing facility has a more institutionalized look and feel to it. When you stay in a skilled nursing facility, it's going to feel more like a hospital room where you're either going to have a private room or a semi-private room. And a lot of the times you're moving into a nursing facility for one of two reasons. Number one, because you need some real skilled care that maybe can't be provided in some of the other environments. Or number two, you've run out of money and you need to go on Medicaid and have the state pay for you. In that event, the state normally pays for nursing home care. And then the last bullet point, continuing care retirement communities, these have become quite popular in the recent past, maybe the last 10, 15 years, where it's a neighborhood that you actually move into when you're young enough and healthy enough to still care for yourself. So you move in as an independent living person. Maybe you have your own house or cottage, or you're in a condo or an apartment within this continuing care retirement community, but you're fully self-sufficient in caring for yourself. But the idea is, as your care needs progress over time, everything is provided in this community. So you never have to leave once you move in there. So they'll have assistive services, maybe some home-based services where they come into your cottage or your condo, and then, of course, some skilled nursing services on site as well. So as your care needs progress, they can transition you within the same neighborhood to get all of those care needs that may be necessary for you. So when people think of long-term care, if you just hear the word long-term care, the first thing that comes to mind for most people is nursing home care. But believe it or not, people that have long-term care insurance policies and the data that's been measured, most people are using those policies for home and community care. So, you know, it used to be, and this is probably a way back in the past thing. I think people have gotten a more wise to what long-term care is over time, especially because of baby boomers taking care of aging parents. But usually when you said, oh, let's talk about long-term care insurance, they say, no, I'm never going into a nursing home. I don't need that stuff. But long-term care insurance is really designed to help keep you in the home and community as long as possible and help your family take care of you so you hopefully don't ever have to get to the point to move into a nursing facility. So unfortunately, a long-term care situation is more likely to happen than many other situations that you insure against. So if you, or once you reach the age 65, you have a 70% chance of you alone needing long-term care at some point in the future. And if you're married and we're talking between you and your spouse, that's a 91% chance that one of the two of you is going to need some form of long-term care sometime throughout the remainder of your life. So unfortunately, the numbers are pretty significant, and there is quite a high probability of potentially needing long-term care. And for us women that are on the line, we're even worse because 2 out of 3 claims are paid for women who need long-term care. Statistically speaking, women live longer and find ourselves widowed later in life and are more in need of care than our male counterparts. So 2 out of every 3 claims is for a woman. So if you're shopping long-term care insurance, you're likely going to find that the premiums for women are higher than the premiums for men because we're more likely to use it. And hey guys, if you ever get to the point where you need to go into a nursing home, I can promise you you'll be very popular there because it's about a 10-to-1 ratio of women to men in nursing homes. And from what I understand of any men that have lived in nursing homes, they become very popular once they move in. And this is just a quick visual graphic comparing other types of insurance and the risk of actually using those insurance benefits. So the top left-hand corner shows the risk of you having a home fire and using your homeowner's insurance. The box to the right of that is the odds of being in a major car accident. The bottom left shows the odds of being hospitalized to a major extent. And of course, the bottom right are the odds of needing long-term care at some point throughout your life. So what does long-term care cost? And it can be quite costly. And because I didn't know what states would be represented on the line, I do have a couple states up here on the screen. I think I took care of many of you, believe it or not. So that was pretty good guessing on my part. But you can see this would be for somebody who needs pretty intensive care and what their care costs would be for full-time home health care, somebody being in your house 50, 60 hours a week, assisted living apartments, nursing home semi-private room, and nursing home private room. And these are annual per person figures for long-term care. So if we were going to take like a national average across the board and kind of talk about different situations of expensive care needs versus more minimal care needs, maybe in the beginning, when you get to a point where you need care, maybe you just need somebody to come in a couple days a week to help your family take care of you because you're not too bad. Well, something like that. Maybe you have somebody coming out 25 hours a week or 15 hours a week, even right in the beginning, before it starts to become more intensive and needing more help around the house. But home health care, for most of the people that we're talking with, we find that their prices range from about $3,000 to $6,000 a month for home health care. That's for an estimated 25 to 60 hours per week of care. Of course, 25 hours would be closer to the 3,000, 60 hours would be closer to the 6,000. Assisted living apartments, we can find, if you look up a national average for an assisted living apartment, some places will even tell you that it's as little as like $3,000 or $4,000 a month. More than likely, that is probably not an assisted living apartment that you would want to stay at if you had all of your choices. It's not as nice as some of the fancier ones that are out there. So most of our middle class to higher middle class assisted living, we're looking somewhere in the ballpark of about $5,000 to $8,000 per month. And for a nursing home semi-private room, maybe private rooms in some areas or some geographies across the United States, $10,000 to $13,000 per month for a nursing home. But what we need to keep in mind is that these costs go up with time, with inflation. So the average inflation rate on these types of services is about 3% per year, give or take. So if this was inflating at 3% per year, the cost is going to double in about 25 years. So if you're on the line and you're listening and you're 50 years old, you can pretty much guarantee that your cost, hopefully you never need long-term care, but if you do, your cost would be much, much higher than what it is today, because hopefully if you do need it, it won't be for quite a while to come. And so lastly, just kind of trying to paint a picture here for you of what we see in long-term care claims. And the reason that I'm doing this is because I typically find that long-term care insurance, it's not an all or nothing type planning process. People don't come in and say, hey, if I can't insure for the $13,000 nursing home bill, I'm just not going to insure against anything, because let's be honest, an insurance premium on a plan that's going to cover a $13,000 a month nursing home bill for as long as you need it, that's going to be a pretty big insurance premium. And for many people, they can't afford that insurance premium, or even if you can, you may say, hey, I really don't want to give all that money to an insurance company every year for something I may or may not ever need. So what we do is we look at the statistics and say, okay, what are most people using in long-term care? What do those averages look like? Maybe what I can do is get a protection plan in place that's going to take care of most likely situations, most of what's going to happen to me. And then if I need more care, I can supplement it with some of my own dollars. But this is really going to help me manage my own retirement assets longer and better, because there'll be an insurance policy in place to pay for the most likely situations, or kind of quote unquote co-insure, where the insurance company pays for some of it and maybe you use some of your own money to pay for some of it, but you're not paying the full boat on your own. So in any case, the average length of claim of somebody who needs long-term care services across the board is about 3 years. For us women, it lasts a little bit longer, closer to 4 years, and for men, you're more around 2 years on the average claim need for long-term care. So across the board, it's about 3 years that people may need long-term care when they get to that situation. So what are your funding options for paying for that? We could look at government resources. We can look at family, either family paying for it or family providing the care for you, using your own money to pay for care, or insurance. So let's go through a couple of these real quick, and then we'll talk more in detail about the protection strategies. So long-term care insurance, I'm just going to list out a couple of the plans that you may think already have benefits in them for long-term care. So medical insurance, like your group health insurance, if you read the policy, which may be in your employer's office, you may not even have a full policy certificate to read, but it will have an exclusion in there for what's called custodial care or personal needs care. So it will pay for medical things like physical therapy, speech therapy, occupational therapy, rehab type stuff, but it won't pay for the everyday, okay, I've gotten to a point where I just can't care for myself anymore and I need somebody to come in and get me dressed in the morning, help me get out of bed, and give me a bath. You know, that's medical insurance excludes those types of custodial or personal needs from your plan. And disability insurance is great. And if you don't have a policy, you may want to talk, to somebody about getting one. But what it's designed to do is it's designed to replace your income. So if you get to the point where you can't work any longer because something's happened to you, disability insurance will pay you up to 65% of your income. But at that point, you've lost your regular income, so you need that money to pay your bills. And when you become disabled, many times there's care needs on top of that, which have an additional expense. So disability income in and of itself is going to continue to pay your mortgage, your kids' college education, whatever may come up, but may not provide for enough money to also pay to hire yourself some help. Medicare is the same as health insurance. Now, this is a copy of your Social Security statement that you see on the screen here, which of course, they don't mail these out anymore. These are all online. But when they did mail them out, it says right in there, Medicare does not pay for long-term care, so you may want to consider options for private insurance. So again, it will pay for rehab or therapy type services, but not help with everyday needs. And then Medicaid. So Medicaid and Medicare are a little bit different. Medicare is the health insurance that becomes available to you when you turn 65. That comes available to everybody, as long as they're, lived in the United States for a minimum of 5 years and paid some Medicare taxes. But Medicaid is more likely what people would use to pay for long-term care bills that came up. The problem is, in order to qualify for Medicaid, you have to be at federal poverty limits on your assets in order to gain benefits through the Medicaid system. So what that means is if you're a single person and you want to go on Medicaid to pay for your long-term care bills, you can only have about $2,000 to $8,000 in assets in your bank account, your retirement savings, vacation properties, anything you can think of. You would need to spend down to $2,000 to $8,000. And guess what? They don't let you give it away. They look at all of your financials through all the past 5 years, where the monies go and the cash flow. It's really kind of a big pain in the butt to apply for Medicaid, but for those that need it, it's great that it's there, but they're going to look at everything. They want to make sure that you didn't give your money away to your kids or your favorite charity or something like that in order to qualify for Medicaid. They want to make sure that you're using your own money first, and then once you reach poverty level, they'll kick it in. Now, if you're married, you can keep a little bit more money. You can keep up to 50% of your marital assets, and that's anything titled in your name or your spouse's name or a combination of both. They don't discriminate. If it's all titled in your spouse's name, it's still considered a marital asset for Medicaid purposes. They'll let you keep half of it, but to a maximum of approximately $130,000. So if you have $100,000 in marital assets, you'll have to spend down to $50,000, 50%. But if you have $1 million in marital assets, you have to spend it all down to $130,000. And I'm sure many of you can appreciate that a surviving healthy spouse who has many years left in retirement, $130,000 may be difficult to fulfill that retirement plan that you once had in place on the way you wanted to live. And then in addition, when you qualify for Medicaid, they still make you use all of your income, your Social Security, your pension, all of that stuff. They make you use it on your own care each month, and then they just kick in the difference. They'll let you keep about $45 a month for personal expenses. Not quite sure what you can buy with that, but all of your other income would go towards your long-term care bills, and then Medicaid would pay the difference of what your income couldn't cover. So it's really a last resort program. It's not something to make a plan on as to this is how I'm going to pay for my long-term care. So having said that, most of the responsibility falls back onto the family members. In fact, 80% of care that's provided in the United States is through family members. So when you're doing your planning, think of it two ways. Who would you be responsible to care for? And have you talked to this person yet and what their wishes are and how that's going to play out? And do they have any insurance in place to help you do that? And number two, who's going to be your caregiver and how can you make that job easier for them? Because the impact of family caregiving could be quite significant, and many of you on the line may have we're called the sandwich generation, where you're taking care of elderly parents at the same time you're trying to raise a family and still continue to work. And that can have a lot of not only stress and emotional and financial impact, but you have missing work, providing care after work, less time with family, missed opportunities, maybe a turned down promotion that required travel, and then the significant financial and emotional stress that's involved with that. Family relationship, if you've ever, maybe cared for a parent, did that, impact your relationship with your siblings? There's always one sibling that steps up and does more than the other siblings, and vice versa. And sometimes that can create kind of stressed relationships within a family. So what I always say, and this is something, I've had this slide in my presentation. I've been doing these long-term care presentations since 2005. And this is the one slide I put in the very beginning, and I've had it all the way, because I truly believe that any amount of long-term care insurance really helps provide quality of life for your family caregivers. Because if they're responsible for caring for you full time, if you have anything in place that can help them any amount of time, even if it's only somebody coming in 15 hours a week, that's 15 less hours that they have to be responsible for. That's so they can juggle their schedule and have someone there on the times where they're really busy, and let them be there on the times when they have more time available. So I truly believe that long-term care insurance helps preserve the quality of life for your family caregiver. Okay, so how does long-term care insurance work? Now we're going to talk specifically about long-term care insurance policies, and there's 4 different protection strategies that we're going to go over, but they all kind of follow the same model of how you trigger your benefits and how you gain access to funds. So with any type of long-term care protection, for the most part, the way it's going to work is the insurance company provides you an account of funds. Now think of it like a bank account. Now, it is not a bank account, it is an insurance policy, but if you think of it like a bank account, you decide how big of a bank account do I want, 100,000, 200,000, 500,000 in that account. And it sits there and it's ready for you when you get to the point where you need long-term care. And when you need long-term care, you start making monthly withdrawals out of this account to hire help. Now, you decide at the time, do I want the help to come to my home? Do I want to move to assisted living? Do I want to go to a nursing home? And as your needs progress, you can move where these services are provided. Maybe you start off in the home and then go to assisted living. You can change all of that. The money is just sitting there for you to use on any types of those care needs when the time comes. So think of it like a bank account. You choose the size of your bank account. You choose how much you want to have access to on a monthly basis. Maybe it's $3,000, $5,000, $8,000 a month that you want to be able to draft out of this account when you get to the point where you need care, and then you use that money for your care needs. So they're all going to work in that similar fashion, and they're all going to have a very similar definition for how you gain access to the account and how you can start withdrawing funds out of it. And they call that, quote unquote, triggering your benefit. So in order to trigger your benefits, you need to have, or you are in need of help with at least 2 of your 6 activities of daily living. So I mentioned them earlier: dressing, bathing, eating, toileting, transferring, which is getting in and out of a bed or a chair, and continence. So if you need help with 2 of these, you qualify to start gaining access to the funds. Now, the cool thing is that the definition is not super strict, because the policies are designed to use for long-term care, so they don't want people, just using their money to hire somebody to clean their house because they don't feel like cleaning their house anymore. They want to make sure that you're really in need of the money before they give it to you. But they make the definition a little bit flexible, so you don't have to be really, really bad off to collect. So they say hands-on help qualifies, meaning somebody needs to physically dress you or physically lift you out of that chair to a standing position, or stand-by help also qualifies. That's written into all of the benefit language, meaning you can shower on your own, but you need somebody in the bathroom to make sure that you're safe, or if you yell for somebody, they're right there to grab you or to help you in and out of the bathtub. that's standby help, somebody not physically helping you, but within a couple feet away in case you need their help. Same thing goes for transferring. You can get out of your chair by yourself, but you need somebody a foot or two away in case you start to become unstable and start to fall. So maybe they don't have to physically lift you up, but they want to be a foot or two away in case you're needed. That's standby help. So hands-on or standby help will, quote unquote, trigger your benefits. Or if you have a cognitive impairment, things like dementia, senility, Alzheimer's disease, where you require supervision. So maybe physically you're completely fine. You could do everything on your own. You're physically capable, but you need somebody in the home so you don't put yourself in harm's way. You don't leave the stove on, take the wrong medications, wander outside the home and get lost, things like that. So between your family and your doctor is ultimately the one that says this is going on. That's what's going to happen if you call an insurance policy. They're going to send you a form that your doctor fills out that says this is happening. If your doctor thinks you need help with your daily activities or your doctor thinks you need supervision, that's going to provide you access to these funds. And I did see a question come in the chat box. I'm going to be tabling all questions to the end, but I do appreciate you typing them in as you think of them, so that way we have a nice list of questions at the end. So thank you for volunteering the first question there in the chat box. Okay, so one of the things that I just wanted to touch base on is something that's going on in Washington State right now. And I know we don't have a ton of people on the line from Washington State, but this is something that you're going to want to know about because there are many other states that are proposing something very similar. In fact, let me just tell you what other states are proposing the same thing that I'm about to tell you about that's going on in Washington this year. So the states that have serious proposals out for this same event would be California, Hawaii, Maine, Michigan, and Minnesota. And then the other states that are still talking about this, they don't have formal proposals that they've drawn up yet, but they're still in talks about moving in this direction, are New York, Oregon, Illinois, Missouri, Colorado, Utah, North Carolina, and Florida. So if any of those states are states that you reside in, this is going to be something that you want to listen to as well. And quite honestly, for any of us other folks in the rest of the United States, if a couple of these states move forward with this plan, you better believe that your state's not going to be too far behind, because normally once one state gets away with something and starts doing it, the other states follow suit. At least that's what we've seen historically with long-term care things. So in the state of Washington right now, 2021, they are implementing a new long-term care payroll tax that will be effective on January 1st, 2022. What they're going to do is they're going to take 0.58% of your income as a long-term care payroll tax. This is a mandatory tax. If you work in the state of Washington, you have no way to get out of it unless you purchase long-term care insurance on your own. That's the only way you can avoid the tax. You have to, in the state of Washington, you have to have a long-term care private insurance policy in place by November 1st of this year in order to avoid this payroll tax. And for people that earn, I would say $100,000 or maybe $75,000 or less, the payroll tax is somewhat comparable to the cost of an insurance policy, but they're going to tax your salary, your bonuses, your company stock. There's no income cap. So if you're at a higher income level, this could be quite an expensive tax for you, and you can certainly do better by going on your own and getting your own policy. So basically what's going to happen is everybody has to pay this tax. In order to qualify for the benefits, you have to pay in for a minimum of 10 years. So for folks that are approaching retirement already, they may pay this tax and never actually qualify for a benefit because they don't meet the minimum vesting time frame that's needed. For younger folks, this isn't too bad. But what will happen is once they, quote unquote, trigger their benefits, they will gain access to their account. It's a $36,500 account, and they can withdraw a rate of up to $100 a day to pay for their care. for care provided in the state of Washington. So if somebody lives in Washington and moves out of Washington, there's going to be no benefits for them. And you can see at the bottom of the screen here, I listed what the benefit triggers are. It's a little bit different than what I just told you. They have 10 triggers, and you need to meet at least 3 of them, rather than normal insurance policies have 6 triggers and you have to meet 2 of them. So it's just a little bit different the way it works. But basically, it's the state of Washington saying, you know, you really need to think about long-term care planning, because this is really putting a huge burden on our Medicaid system and the state paying for care of people that didn't plan and they got to poverty level, and now we're paying for their care. So what the states are trying to do is they're trying to force people to, you know, protect themselves on their own privately, and they're saying, okay, if you're not going to, then we're going to force you to through a tax. So the pros are it's getting people to think about long-term care. That actually is what prompted the webinar this year and offering these webinars, this tax that's coming out. So it's good. It's getting people to think about it. It does provide some benefits available, and there's no medical questions to qualify for this. Like with long-term care insurance, if you apply for a private plan, the insurance company is going to ask you some medical questions when you apply to make sure that you're healthy enough now, basically that they don't anticipate you're going to be using it real soon. So they ask you medical questions, and if you're not healthy enough, you can't buy private long-term care insurance. So for people that aren't healthy enough, this gives them access to benefits, which is good. And for people that are, you know, middle wage earners, this provides an inexpensive way to get some type of long-term care insurance. So I did some numbers, I did some analysis, and if you're under the age of 40 or an income lower than $75,000 and you plan to live in the state of Washington and retire in the state of Washington, the tax could be more cost effective than private planning. But if you're outside of that criteria, then of course private planning would make more sense, or if you plan on moving later. And again, I know a lot of you don't live in Washington, but these are all good things to know. Here are the cons. I'm just going to kind of read through this list real quick. The benefits of an individual long-term care insurance policy are far superior to those offered through the state plans. They can only be used in the state that that's offering the tax. So if there's no reciprocity between different states, if you retire somewhere else, it's limiting you to about $36,000 in benefits. It's only available to the taxpayer and not the dependent. So I did see a question in there, is this tax strictly for an employee? Yes, you're taxing the employee and the benefits are only available to the employee. The dependents are not eligible to pay the tax or get the benefits. All individuals are entitled to the same benefit max, so higher wage earners that are paying a lot more in just by virtue of their income being higher, they're getting the same benefit as, you know, the person who's paying based on a $40,000 a year wage. Employees that have less than 10 years from retirement may never fully be vested and may never have access to benefits. This one I think is quite interesting, this next bullet point. The providers that they're using, or the way they're reimbursing on these state plans, is comparable to how Medicaid does it. And some providers, home health care agencies, assisted living, and even nursing homes, don't want to be constrained to the Medicaid caps on the rates they're allowed to charge. So there could be an issue with finding providers that have, you know, services available, or there could be maybe some balanced billing where the provider says, I'm not willing to accept that Medicaid limit on the fee that they're saying I can charge. I'm going to come back and charge you the difference. The rates are not guaranteed. They said that they're going to do a reevaluation every 3 years to see if the rates need to go up or the tax itself needs to go up. And $36,000 a year in benefits right now isn't worth a whole lot of money. Imagine how much it's going to be worth 25 years from now when prices go up a lot. So they're talking about making benefits that could potentially go up with cost of living, but it's all going to depend on how solvent the fund remains and if there's enough money coming in to allow for cost of living increases on the benefits. So that's not guaranteed. Okay, so thank you for giving me that opportunity to go over the Washington state tax. Just bear in mind that if it's not in your state yet, this could be something that you could hear about in the next 1, 3, 5 years. If you're between the ages of I would say 45 and 65, that's kind of the sweet spot for long-term care, private long-term care planning, where premiums are still affordable enough that it makes sense to move forward. Hopefully your health is still good enough that you can qualify. If you are younger than 40, it's going to be hard to get a private long-term care insurance plan. A lot of companies don't offer them to people under age 40. And if you're over age 65, we do have lots of clients that still do planning on that time, because we talk to people that are going into Medicare and, maybe they haven't planned yet. So we do lots of planning at age 65 and 70, but the plans become a bit more costly at that time. So we find that in those age ranges, people are buying smaller benefit amounts, at least to be helpful to their family, just because the premiums become a lot more expensive at that age. Okay, so let's talk about the different types of protection plans that are available when you're planning. So we have 4 different types. There's traditional long-term care insurance, life insurance that has long-term care riders, something called asset-based insurance, and short-term care insurance. So I'm just going to kind of give you a summary of each one of these and why people consider one over the other. So traditional long-term care insurance, that's probably what you've heard most about. This is insurance put in place for the sole purpose of protecting you against long-term care needs. So remember, we're getting that account of funds, gaining access to that account of funds. So in a traditional long-term care insurance plan, that account of funds is only available if you have a long-term care need. If you don't have a long-term care need and you pass away in your sleep peacefully one night, then you paid for insurance for peace of mind of knowing that you would have protection in case you ever needed it. Kind of like a homeowner's insurance policy. If there's no home fire and there's no claim, then you paid just for the simple fact of knowing that it was there if you needed it. So it serves one master, and the master is in need of long-term care. Because of that, it is going to be the most cost-effective way to protect against long-term care risk. It's designed to pay for long-term care. Its only purpose is to pay for long-term care. It's going to provide you the most cost-effective way to pay for long-term care services, if that's your primary concern. And you'll see I have $2 signs there because it's an affordable for that purpose. Now, the next step up from that would be something that's called life insurance with long-term care riders. So again, let's think of the same thing. We have our account of funds that we gain access to when we need long-term care, but this actually serves 2 masters. You can gain access to the funds if you need long-term care, or if you never need long-term care, or you didn't need all of the funds for long-term care, those funds get released upon your death as a tax-free death benefit to your beneficiaries. So this plan serves 2 masters in need of long-term care, or if you die. The way the world works, that's a guaranteed payout. One of those 2 things, or maybe a combination of both of those things, is definitely going to happen to you at some point in the future. So with this type of plan, there will be a guaranteed payout either in life, in death, or partial of it in life and the remainder of it in death for that account of funds. So this one is a bit more expensive, so I put $3 signs for that. The next one up is asset-based long-term care. Now, asset-based long-term care is interesting, and it fits a certain demographic. If you are on the line and you're saying, this long-term care insurance stuff sounds good, but I have enough money. If I ever needed long-term care, not that I would want to pay for it, but I could afford to pay for it. And I'm not a true believer in insurance. So why do I want to give my money away to an insurance company for something that may never happen to me? Those are the type of people that like the asset-based plan, because what they do, and I'll just give you a quick example. With asset-based insurance, let's say you say, okay, I'm making up these numbers. Let's say I have $100,000 and this is my emergency fund. If I ever need long-term care, this is where I'm going to grab from first. Instead of leaving that $100,000 in, something real liquid, so it's easy access, like a money market account or something that's not earning a whole lot of interest, transition that into this asset-based long-term care plan. And what will happen is that $100,000 turns into about $300,000 to $500,000 if you have a long-term care need. Or if you don't have a long-term care need and you die, the $100,000 turns into maybe, and I'm making up these numbers, of course, but the concept is right, turns into maybe $150,000 in a tax-free death benefit. Or if sometime down the road, you say, you know what, forget this, I'm moving to Florida or I'm moving to the Bahamas and I'm just going to enjoy the rest of my retirement on a cruise ship, and you want to cancel your plan and take your money. Well, your $100,000, you may not get 100% of it back, but they'll give you the bulk of it back, maybe $85,000 of it. So this plan, it transitions an asset that would otherwise be a liquid asset that you would do for your own long-term care planning purposes if you were going to pay for it on your own, and you make it work better and harder for you. So this plan serves three masters. If you need long-term care, or if you die, or if you decide you just want to cancel it and you don't want it anymore. In that event, this plan is going to pay. So definitely a guaranteed payout here. I have $4 signs next to this one, primarily because, not because the insurance itself is more expensive, but because a lot of the times people pay this in a single lump sum rather than paying it monthly or annually over a period of time. And so for some people, the cost could be prohibitive if you had to come up with a large lump sum of money to transition into this plan. And then the last type of strategy that I have listed here, and I will preface this by saying short-term care is not available in every state. There's probably about 15, 20 states in the United States where we have short-term care plans available. Pennsylvania and Maryland, I know those are two of the states on the line. I know we do. I'd have to look up some of the other states on the line. I apologize. I don't know off the top of my head. But short-term care is just kind of a baby version of a traditional long-term care plan. It works the same, except at smaller dollar figures. Maybe it compares to that Washington state plan where you get $36,000 in benefits or $72,000 in benefits. It's designed for not only using for long-term care situations at a lower dollar amount, it just doesn't pay out as much. But this is kind of cool for two reasons. Number one, the underwriting is less stringent on this plan. And I did see a question come in asking how stringent the underwriting is for long-term care insurance. So I think this is a good time to talk about that. Traditional long-term care and life insurance with long-term care riders, underwriting is pretty stringent. High blood pressure, high cholesterol, probably not going to be a big deal. They're looking for major conditions that are not controlled, like I have diabetes and my doctor's still trying to figure out the best mix of medicine. One of the medical questions is normally, has anything changed with your meds in the last 6 months? They don't like to see a lot of fluctuation. They also don't like to see physical impairment. So a lot of the times I have these healthy 45-year-olds that say, oh, I exercise every day, I'm so healthy, blah, blah, blah. And I say, okay, when's the last time you've been to physical therapy? Oh, well, I just tore my rotator cuff, or I just, had my meniscus repaired and I had physical therapy for 6 weeks. So they don't like to see physical ailments that need rehab. Not that that would disqualify you forever, but they would say, okay, get the physical therapy done, wait 6 weeks to show that you're fully recovered, and then we'll consider your application for a plan. So they're looking for more major health conditions that are not real stable yet, and physical ailments that you're receiving like current physical therapy on. Pain issues also are a concern because chronic pain is one of the biggest debilitators later in life. So those would be concerned for the life insurance base. The asset base is a little bit easier because remember, you're giving them a larger lump sum up front. So you're quote unquote kind of self-insuring the first $50,000, $100,000, $150,000, and then the insurance kind of is tacked on the back end. So those plans are a little bit less stringent on underwriting. But short-term care is super easy. It's like a 5-question yes or no, dreaded conditions like do you have MS, dementia, senility, Parkinson's disease, muscular dystrophy, things like that. If you answer no to those, you're generally accepted. So we can get more people through on this plan. And also, it's for not only long-term care needs, meaning your doctor thinks that the need's going to continue for at least 3 months or longer, but it can also be used for short-term care needs, like I just got a knee replacement and I need somebody to come in, I live alone, I need somebody to come in and help me out for the next 3 weeks while I rehab at home. those shorter term situations can be used. You can use the funds for that on a short-term care plan too. So I like these plans. The problem with short-term care is they're not available in a ton of states yet. Hopefully it'll spread more as time goes on because I think they're pretty neat. Okay, so I'm going to spend a couple minutes in talking about traditional long-term care in a little bit more detail. If you want to talk about any of the other strategies, I would recommend that you give our office a call and we will put together, quotes for you, organize everything so you have something to look at and consider. But long-term care insurance is designed for people who recognize the need for long-term care. Maybe you've been a caregiver before, so you actually believe, hey, although I don't ever expect this to happen to me or want it to happen to me, I know realistically something could happen to myself or my spouse. People that are looking for the lowest cost approach for comprehensive long-term care protection, people that want to make sure they're covered for that. And although it's great to have all the bells and whistles with other payout methods, this is really what I'm looking to ensure. And also something I didn't talk about yet, which is partnership protection, which I'll talk about that in just a minute when I get to the slide. That's a partnership between you and the state Medicaid system to allow you to collect state-funded benefits, even if you're not at poverty level. Okay, so I already talked about how the plans are designed. You have an account of funds. In this example, it's a $100,000 account of funds, a monthly withdrawal rate at $3,000. We've attached a 3% interest rate to it. So when this person gets to the point where they need care, they start taking these monthly withdrawals out to pay for their care at home, assisted living, adult daycare, or nursing home. But then we've also attached this 3% interest rate to it because we know costs are going to go up. So every year, this policy is going to be worth 3% more compounded from the prior year. So I've summarized it in 5-year increments here. If you're 50 right now, 30, 35 years down the road, you can see your 100,000 has grown to 240 plus thousand, and your monthly withdrawal rate is no longer $3,000 a month, it's $7,200, $7,300 a month. So we can design the plans to grow with interest year over year so they can help keep up with rising costs. And some of the things that we can do to kind of hedge against that use it or lose it concern, like what happens if I never get sick? Does my policy just go poof when I die? And yes, it kind of does. But if you're married or you have a significant other that you live with or some kind of, relationship where you're living in a committed relationship with somebody, what you can do is we can merge your plans together. So in this example, one person has 144,000 in their account, the other person has 144,000, but we've joined them together with a shared care rider. So now there's 288,000 between the two of you. So if I need long-term care and I use up all my 144,000, I can take from my spouse's 144,000. Or if I die and never use any of my 144,000, my spouse retains all of my benefits plus all of his benefits. So it makes whatever, who knows who's going to be the person that needs care, me or him or my significant other. So making both policies available to whomever needs it for as long as the survivor may live really helps with that flexibility and kind of gets rid of the concern about, well, if I never use it, will I lose everything? And then the other thing I just want to impress upon you is, like I said, it's not all or nothing. And even a small policy, you may say, well, a nursing home costs $13,000 a month. What's a $2,000 a month benefit going to do for me? Well, $2,000 a month will pay for about 20 hours a week of home care. So if your daughter who lives 15 minutes away is going to be your ultimate caregiver because she wants to and you want her to, and she's a stay-at-home mom and she is not working full-time so she can do that, well, 20 hours a week could allow her to get some stuff done with her own kids and some other things that she needs to do so she can come in the morning and come at night, or she could arrange the hours that she's there with you and know that she has somebody paid coming in to take care of you 4 days a week for 5 hours to give her some relief. So I always say these smaller plans are like family helper plans, something that's going to pay for 15, 20, 30 hours a week of home health care could still be very valuable to your family and keep the premiums affordable. All right, So the last thing I'm going to talk about before I get to the premium comparisons of the different types of strategies is this partnership protection. This is something that's pretty cool that's available in, I think, 50 states right now. If not 50 states, certainly very close to it. It's a partnership between the insurance company and the state Medicaid system. So remember, I told you before that if you ever wanted to go on Medicaid to Medicaid to pay for your long-term care expenses, you would have to spend all your money and have no savings left in order to qualify. Well, what this does is say, you know, I know you tried to take care of yourself. You bought $100,000 in long-term care insurance, but that just unfortunately wasn't enough for your situation. But we recognize that you tried to protect yourself. So what we're going to do is, instead of making you spend down to poverty level, we'll let you keep $100,000, the amount that you insured against, in addition to whatever you can keep anyway based on the poverty limit. So let's just give you an example. You have, $50,000 in assets and you own a $50,000 long-term care insurance plan. This person, if they exhausted their long-term care insurance benefits and needed more care, they would actually have to spend down nothing and go directly onto Medicaid because they've protected their $50,000 with $50,000 of insurance. This person has $200,000 and they bought a policy worth $180,000. When they use up that $180,000 in benefits, they only have $20,000 of their own money to spend down before they can go on Medicaid because they've protected the $180,000. You know, same thing. Have $1 million, protected $500,000, only have to spend down $500,000 to go on Medicaid. And the last person had no insurance, and of course they had to spend down all their money to go on Medicaid. So it's dollar for dollar asset protection. Every dollar you buy in insurance, the state will say, thank you for trying hard. I know it wasn't enough, but we'll let you protect your own money in an equal amount. And that's only available on traditional long-term care. All right, so, and I think the bottom part of this got cut off a little bit on the slideshow, but right here, these are the benefits that we just went over. Traditional, actually all types of insurance are going to provide tax-free monthly and benefits or lump sum benefits for your care. Any of the strategies, all the benefits are always tax-free, whether they're used for long-term care or if it's a death benefit like in these two type plans here. Premiums can be tax deductible in long-term care insurance. Traditional long-term care offers inflation, shared care, and partnership protection. Now, if you're looking for something that has a guaranteed premium, you know, maybe you've heard that you've had some friends that had traditional long-term care and they've gotten some premium increases because some of the older policies certainly have. You can see these type plans have guaranteed premiums. They have the death benefit, but they're more expensive. And then the short-term care over here, they're good for shorter term needs. They don't have as much medical qualification to get the insurance, so they're good for those type needs as well. Okay, so I'm just going to wrap this up real quick with some sample premiums just to give you an idea. Now, this is for a couple age 55. Both, now it's a male and female couple. So if it's two females, it's probably more expensive. If it's two males, it's probably less expensive because traditional long-term care is more expensive for females. $150,000 per person benefit account, $3,000 a month withdrawal rate, the shared care rider, so it's really $300,000 between the two of them. If we don't add the 3% interest on it, it's $176 per month premium for combined between both people. If we do add the interest benefit, so the benefits go up year over year with guaranteed interest, that does bring the premium up, at a pretty substantial rate, but that's because 30 years from now, your premiums, or your benefits are going to be more than doubled what they are today. The life with long-term care, similar, $150,000, $3,000 a month, has $150,000 death benefit. You're looking at about $340 a month without inflation. So if I just go back, $176 versus $340, but now you have a guaranteed payout. Whether you live or don't live, there's going to be money paid back. Asset-based, unlimited. This is with an unlimited per person benefit, so it's not capped at $150,000. It will pay $3,000 a month as long as you need it, even if you're 55 years old when you go on claim. If you don't use it, the beneficiaries would get $100,000 back as a death benefit. If you don't do the 3% interest, it's going to be about $67,000 for the couple to buy a plan for this as a one-time payment, or about $360 a month over time. Single premium with the interest built in is a little over $100,000, or about $510 per month over time. And the short-term care, this is for 1 year of benefit at $3,000 per month. First day start, it starts the very first day you need it. So your doctor says you need care, you can get somebody in there day one, $42 a month without any interest benefits built into it. They're not available in this type plan. So I hope that gives you an idea. A lot of times people are like, what is this going to cost me? I hope that gives you an idea of some price ranges. If you're younger, of course, it will be less expensive. If you're older, it will be more expensive. So that's what I have for you today. I'm going to close this up, and then I'll go back in and review some of the questions that are in there. But long-term care insurance is medically underwritten. So the younger you are when you start, the better the pricing, the easier it is to qualify. We would love to be your resource for long-term care planning. So just give our office a call. The number's up on the screen. Our email address is up on the screen, and you can call at any time, and we'll get an appointment scheduled for a date and time that's convenient for you and any family members or loved ones that you want on the call. We'll go through everything with you. We'll put together rates that are specific to your needs, and we'll put together a detailed email with all of the details that we discussed, so that way you have something to review with your family and consider. So please let us know if we can help in any way. So I appreciate your time today. Thank you so much for listening. If you have to disconnect from the line, please go ahead and do so now. I won't be offended. We have about 2 minutes till the top of the hour, but I am going to take a couple minutes here and just go through any questions that came in and review them. If you disconnect from the line and you had some questions, I will email you the answers to those questions. Do you have some resources for caregivers, links, guides, etc.? I don't know that I have anything formally put together for caregivers to use. I assume you mean like different strategies for how to take care of your loved ones and ways to find free services and stuff like that. I really don't have anything formal put together. What I will tell you is if you have long-term care insurance, all of the policies have what's called a caregiver training benefit or a care coordination benefit, where they will help your caregivers that are taking care of you take care of you better and make it easier for them. So all of the insurance companies do have those types of free services available. I can see if there's something specific that you're looking for, reach out to me, and I'm sure I can find you some resources if you're going through a caregiver situation right now. Is there a best time of life to buy long-term care? I think I may have mentioned that after you put this question in. The sweet spot for planning is between ages 40 and 60 or 40 and 65. Is the LTC Washington tax strictly for employees? I've answered that one, yes, strictly for employees. Is there no employer portion? Who pays the tax? The employee pays the tax. Some employers, I guess, could opt to do so, but the way it's designed now, it's an employee paid tax. If you work part-time in Washington State, do you still qualify to participate? Yes. If you are receiving income, you will be taxed the 0.58% of your income on the income tax. So yes, you can still participate. There might be some minimum hourly requirements to build your vesting. So it's the equivalent of 10 years. That hasn't been specifically outlined yet, though, that I've seen anyway. We talked about underwriting. How do employer long-term care plans compare against private plans? They're generally the same. A lot of the times the employer plans may not offer all of the bells and whistles that you can get if you purchase on your own, but the general makeup of the plans are the same. If you have an employer plan that you're comparing against now and you can provide us with that literature, we could give you more detailed information on how it compares to what you can get in the free market. But don't automatically assume because it's an employer plan, it's going to be lower cost and premium. I would recommend that you do some comparative quotes to see, because just because it's from an employer doesn't mean it's necessarily less expensive. And then I have some thank yous. Let me see if there's any other questions. our dependents required to enroll in the program since they have summer jobs, same as my wife and I? There might be a minimum age, but if there is a minimum age, I believe it's like 18 or something like that. So if you have children that are working summer jobs, they may have to enroll in the program if they don't have private insurance. Can benefits be paid to your caregiver if they are related to you? Typically, long-term care insurance is not going to pay family caregivers or friends unless they're employed by an agency. The policies are really designed to pay professionals, and your family and friends are going to help out where they can anyway. But some policies have cash benefits built into them that give you a little bit extra that you can help share with your family caregivers. So if you're looking to pay somebody in your family, you may want to look at a policy that's a smaller policy to hire some part-time help and let the policy pay for the part-time professional help, and then you could use your own funds to help subsidize what that family member may be losing in an income to help care for you or something like that. But we can talk about creative ways to maybe make some of those things work as well. So I know I answered those really quick. If you have any other questions, please reach out. But I really appreciate your time today. Thank you so much for being on the webinar, and I hope to talk with some of you soon. Have a great day, everyone.